Hello and a very warm welcome to Commodity Ki Pathshala, brought to you by NCDX and Moneycontrol, where our exclusive session today is on will the suspension of commodity derivatives tame inflation? It has been a raging debate, and we have a very special panel joining us to talk about exactly that. On the panel joining me is Mr. Subhash Chandra Garg. He's former Finance Secretary, Government of India. I also have with me Mr. Kushankar. He's Chairman, Center for Food and Agribusiness Management, IIM Lucknow. We also have with us Sandeep Bajoria. He's CEO, Sunwin Group. He's also Chairman of All India Cottonseed Crushers Association. And we have joining us Mr. Kapil Dev. He's CBO, NCDEX. Gentlemen, hi. Thank you so much for your time today with us this evening. And we are discussing a very, very special topic right now. I mean, this is something that the commodity derivative markets have been looking at. There has been a lot of keen interest when it comes to price discovery, hedging mechanisms. Stakeholders have been wanting these markets, but then it has been, slightly disillusional because we have seen a lot of bans and suspensions coming in time after time. Especially in the recent times, in the last 2 or 3 months itself, we have seen bans on pulses, edible oil, and then some other commodities, which hasn't gone down well with stakeholders. But let's take this discussion forward. First of all, let me come to you, all of you actually, for your initial comments, how you see this market and how you perceive these suspensions or bans that we've seen coming from the regulator. Mr. Garg, to you first. Thank you so much for joining us. How have you seen the market, the development of it, and how do you read into these bans?
Thank you. I don't think the commodities derivative market play a very large role in inflation. The prices of agricultural commodities are primarily determined by the overall demand and supply situation of that commodity. We have a surplus situation in many commodities like wheat, rice, etc. We also have some shortages commodities like pulses and edible oils. That shortages can be met only by the import. So if we have a free flow of the import regime, that would determine the commodity prices and inflation or the lack of it, not the derivatives prices. So I don't think any measures like not permitting commodity derivatives or suspending them just to cool down some supposed inflation is a good measure.
Sir, you've been in the government and the ministry, and you have been part of various policy makings as well. So, while you do agree that this is not the way to do it and it does not impact, and there have been various studies done on that effect as well, how would you read the decisions then?
See, the problem is that in the agriculture space, the government has been following a policy of excessive interference or in the agriculture space. That is reflected in our MSP policies. It's reflected in our essential commodities control, where the storage and many other controls are exercised. Likewise, there is a perception which is entirely misplaced that the derivatives add to the artificiality of shortages because of the speculative possibilities, but it's too much trapped into this mindset of agriculture being excessively interfered. So I don't think there are short-term solutions, but until we have a basic reset in understanding and adopting a more market-friendly policies, you would perhaps continue to see this kind of knee-jerk reactions from time to time.
Oh, well, and it is unfortunate. And I take your point when you say that there is excessive interference. And that is exactly something that many of the agriculture market participants actually have been feeling and voicing as well. Let me come to you, Mr. Bajoria. And when it comes to edible oil, there's basically nothing really remaining for you to hedge on. And even after we have seen many of the commodity derivatives suspended, it hasn't stopped the prices from rising. One, the dependence on imports is just so high. And two, the fundamentals are way too strong, would you say? Mr. Bajoria, you are
65 to 70%. Just a minute.
No,
Yeah,
we
can you
can
hear
hear
me
you.
now?
I can, yes.
Yeah, okay. Okay, Manisha. Thank you very much, NCDX and Moneycontrol, for inviting me here today, and with the esteemed panel. the former Finance Secretary, Mr. Garg, a very respected bureaucrat, Mr. Kapil Dev, and Mr. Kushankar Dev from IIM, and Manisha, always the best commodity anchor today in India, what we have. So, coming to the edible oils, we import $17 billion worth of edible oils every year, and two-thirds of our requirement is met by imports. And government took a decision last year that they wanted to suspend the futures on oil and oilseed for 12 months, and they did earlier with pulses and other things. But since they have suspended, thinking that the prices have gone high because of the futures and contribution of futures, the international price of crude palm oil at that time was ruling around $1,200 CNF, and soybean oil was $1,300 CNF. And today that 1200 palm oil has become $1,650 CNF. And soybean oil, which was 1300 CNF, has become $1,675 CNF, while our futures were closed, suspended. So international futures on CBOT, Chicago Board of Trade were on, futures in palm oil in Bursa, Malaysia was on, Italian futures in China were on. And all the futures market taking the global cues of supply and demand, geopolitical issues, the futures have gone haywire and physical market has also gone haywire world over. And today in India, without futures, the issue is prices in CNF has gone so high, consumer has to pay. Like if somebody wanted to cover the oil earlier, if futures were there, they could buy from NCDX or MCX and cover their need, the consuming industry and the consuming people. But now those futures are not there, so they could not cover, and they have to pay these high prices through their nose. This is the consumer side I'm talking about. But if you look at the from the side of the farmer, and the rapeseed mustard crop is coming in front now, harvesting is already started, and farmer wants to lock in these prices. So when he wants to lock in these prices because the futures are not there, how does he lock in? The FPOs are there, the cooperatives are there, farmers are there, and they have no way to sell their produce except when actually it is fully harvested and they bring it to mandi and they try to sell it. There is a time lag into it. If futures were there, they would simply sell March and April futures and their mustard seed and then cash the fantastic prices which are there right now. So one side producers, these are farmers, other side consumers and the consuming industries in those hotel, restaurant, bakery, shortening, frying. These people who consume edible oil, they are also have no choice. And because of futures not being there, the price discovery has also become a problem. Today, nationwide, if there's one single futures every morning, soy oil and SIDEX would open, the rapeseed mustard would open, soya seed would open. You would see what is the price, and accordingly, the physical market would take shape. But today, there are fragmented 50, 70 people across all over India. Everybody has his own price. He doesn't budge from his price. He maintains his price, whether you want to buy or buy. If you don't want to buy, forget about it. So it's become a kind of a situation which is the hand of 50, 70 people. And what price they say, the whole pricing power has come to those physical players, which are numbering to 50 or 70. And so earlier the pricing power was in the hand of futures market, and then physical players had to follow the price. So it is completely reversed now. And with this completely reversed situation, you are compelled to buy at which price the physical player in your area or your state is quoting, and actual fully transparent nationwide price discovery is also missing. So the basic tenets of future markets which we see is the price discovery and price risk management. Both are missing link right now. And this is a very big thing. Now this is when the prices have gone up from $1,200 to $1,650 because of three main reasons: that La Nina in South America destroying the soybean crop. Brazil crop was estimated 142 million. Now they are saying 125 million. The Argentina, Paraguay, Uruguay crop is also down by 7-8 million. So total 23, 24 million crop got destroyed. Secondly, Indonesia got a policy of 80-20 that unless and until you sell 20% local palm oil at a subsidized rate to local population, you will not be allowed to export 80%. So that has also created bottleneck. And third and most important factor, Russia, Ukraine, from where our sunflower oil comes. We import 2.5 million ton of sunflower oil. in that region. So much of tension is there, uncertainty is there, whether sunflower vessels will be get loaded, vessel they will ship out, whether in that region new vessels can go in. All this has created a big shortage everywhere worldwide. But somewhere the things are going to ease out, somewhere things are going to uh, become calm, and supplies flow again will start, which may be 1 month now or 2 months now. But when it starts, then the prices which they are $1,679 today, which has gone up from $1,200, can come down by $200 in no time. And when it comes down by $200 in one within a span of 3 or 5 or 7 days, you are again caught. The processors here who have purchased the oil at high rates, how do they hedge? If the futures are on, they can sell or NCDEX their so refined oil, and they will be saved from big losses. And otherwise they will be incurring the huge losses when the market falls. And with the big quantities import happening and such a big fall in the market, the losses can be very high. So I believe in this kind of situation, it is very important to have futures market. It is very important to have futures market in this kind of a situation, without which we are inviting a lot of trouble for producers, farmers. Red mustard crop is coming for processors, refiners, and also the end consumers. So I strongly believe, probably maybe government had its own thinking and the elections were there, so government didn't wanted to have many factors in the market, so they brought it suspension on futures, so stock control and all these things. So I think state elections will be over on 10th of March. Government should immediately call a meeting, and by end of March they should resume the futures market, so that the farmer of rapeseed mustard seed is protected. He get to lock in his price, and consumers and as processors are also having some kind of a protection and price discovery. Thank you.
I get your point, Mr. Vajoria. Well, yes, this is unfortunate, as both our speakers have said. There is no reference point to look at, and there's no hedging mechanism that we have right now. And yes, it's a loss, and it has been unfortunate for various stakeholders there. Mr. Day, let me come to you then. And you have perhaps done a study earlier as well, and this time too, on how there is really no connection between the current market prices, the derivative markets, and inflation in various commodities. Do share that with us, please.
Thank you, NCDX and Moneycontrol, for inviting me in this panel. Now, being an academic, I want to throw some light on the relationship between exchange and inflation. Now, this ban or suspension on the commodities of these commodities has been episodic, and this ban traces to 2007, 2008, then mid 2020. There was some temporary suspension on guar seed, guar gum, and some other commodities. Now, if you see the farm gate inflation or the wholesale price index, which is a key driver of inflation. Now, how this WPI is constructed? Now, WPI consists of food articles, non-food articles, and manufacture of the food products. Fine. Now, it has comprised of 164 commodities that actually cater to this WPI basket. Now, if we take the reference of National Commodity Derivative Exchange, which is one of the largest agricultural commodity exchanges in India, it has only share of 13%, that totaling 21 commodities, including food articles, non-food articles, and manufacture of the food products. You know, contributed by count. Now, this exchange traded agricultural futures has a share of 22% in the construction of wholesale price index. So now you can see there is hardly any relationship between the commodities traded on the NCDX influencing the inflation and pressure on food articles and non-food articles or manufacture of food products. Now, another interesting observation I will present. Now, NCDX has calculated the inflation for food articles and non-food articles and manufacture of food products. Now, if you see the average inflation figures, I have analyzed for cereals, which stood at 12.41% December 2021, pulses 0.93%, oilseeds 24.97%, edible oil 17.72%, condiments and spices of 13.49%, and manufactured animal feeds stood at 22.9%, and others comprising 21.6%. Average inflation traded on the exchange as of December 2021. Now, on the other hand, the non-exchange traded commodities, especially pulses and oilseeds categories, because NCDX except soybean and except a few commodities, two, three commodities, other oilseed and pulse commodities are traded on non-exchange. Okay, so here the pulses and oilseed categories report higher inflation to the extent of 7.09% and 19.69% in December 2021. So, therefore, the SEBI's direction or directive to suspending oilseed and pulse futures contracts might not hold the significance as far as WPI inflation is concerned. Last but not the least, the significant relationship that I tried to explore between the agridex because NCDX, this is an index constructed based on the liquidity, the liquid futures, and the weights of the commodities. So it is basically commodity production percentage, say 50%, and the liquid futures traded on the NCDX comprises remaining 50%. So by rebalancing the portfolio, maybe fortnightly or quarterly, NCDX, prepares this index called Agridex. Now we see the correlation between NCDX and the major, the commodity prices underlying market is basically the spot or ready cash market. It has only 0.487 correlation. So what does it mean? This means there is the weak co-movement between the spot prices or change in spot prices and the agridex, that liquid commodities futures contract traded in the NCDX. Another interesting observation, when you calculate the hedge ratio is coming 51%. So it means that 51% of the underlying can be hedged using the equivalent size of the agridex futures contracts. Okay. However, the hedging effectiveness turns out to be 25.6%. Now, from this analysis, it is quite evident or palpable that this kind of SEBI's move to suspend or ban this 7 active futures contract at least for a year, doesn't hold relevance. So, in hindsight, exchange traded agricultural futures, if thickly, can contain relevant information for value chain actors, and the information is subject to appropriate usage by these actors to strengthen their decision making. In the absence of this market, a forward looking arrangement will not be available. That may increase information asymmetry and catalyzation of unscrupulous actors in the business of commodities. Thank you.
Thank you so much, Mr. Deval. Yes, you made a lot of relevant data points there, and clearly there have been various studies done, and it all throws the same conclusion here that it really isn't about the derivative markets that is taking the commodity prices higher or lower. It is about the fundamentals and various other policies and geopolitics and currencies. There is just so much to watch out for when you look at commodities. Well, let me come to you as well. And in the global markets, the commodity derivatives have been appreciated and have been functional, and no, they have never been suspended for last 100 plus years, 170 years in case of some exchanges as well. Would you say that when it comes to India, we are yet to fully utilize, fully appreciate the fact that we have these kind of products, and the fact that we are a commodity nation, we are an agro nation as well? And I mean, this is something that most stakeholders and supply chains need.
Thank you, Manisha. Can you hear me?
We can, yes.
Yeah. So you are right, Manisha. This is the 15th incident which has happened of suspension in Indian's derivative market. When we talk about economic rationale of having derivatives market, as Professor Kushankar and speakers earlier were saying, was to, giving such a platform where they can manage these volatilities which we are worried for, right? And when this market was started, the point was that farmers who are very fragmented, the information available is quite low. Yeah, it's not reaching to the last mile. By having such kind of platform, everyone having the right set of information, there will be a transparent market mechanism for, and the volatilities which we are seeing now can be managed. But unfortunately, because of certain misconception we have around this market, these on and off bands are happening, and the actual purpose is not being delivered. So I think we are always ready against this thing. Multiple time it has happened. It is not first time. And after every ban and suspension, there is a lot of research. Certain committee were formed. Internal research, external research has happened, and each one of that concluded that futures has no role actually in terms of price inflation, in terms of price movement. There is always a reason, right? When we ban a contract, but it is manipulated. Yes, it may be, but there is no evidence in especially this case. Was market trading against fundamentals? No, it was 90% correlated what spot market was saying. Is it only commodities being traded on the exchange? No, all the commodities, even in the groups where we have, are having similar kind of volatility and price movement. And I would like to mention more than that, right? All the pulses, if you see, the masood has the highest volatility. In oil seeds, groundnut has the highest volatility, right? So all the commodities where futures is not available are also having similar pattern of prices and volatility. And even not agree, the non-agree is also having the similar trend. So this is one that we actually, there is no correlation in futures market. But yes, if these markets are utilized in the right manner and right fashion for which these are meant for, I think the volatility related issues by the value chain participants can be managed. Point number two, the derivatives market is not only a platform, right? It's an ecosystem which brings warehousing, which brings price transparency, which brings standardization, which brings information to the table. And those are being utilized by all the stakeholders, not only by the people who are actually trading. So by banning and suspending, first we are closing out that ecosystem. Second, we are left with no option to hedge, and then we are now much more vulnerable to the volatility. And third, information availability is now nowhere, even the nearby how it's going to happen. Just want to quote one example. Manisha, I was reading that coffee is the commodity in agri segment which has seen the highest volatility, and prices are almost 80% up in a year. And in the same news, I was reading that Starbucks, the largest consumer of coffee, has no impact because they were perfectly hedged, right? So there is one segment who is using this market for the purpose they are meant for. They are managing volatility, they are managing their top line and bottom line, they are protecting themselves. And maybe there is one segment who is always questioning that these markets are not right and these are leading to price volatility. So I think we have to see market with the perspective these are meant for. And once those awareness and more information about these markets are built, these type of interventions may be avoided going forward.
Kapil, you actually gave us a relevance and a comparison within commodities on how volatile they are vis-a-vis one another. Mr. Garg, if you'll allow me, and this is not something that I said, this is as soon as after there was a ban, suspension for 1 year for many of these commodities, we had various market participants and stakeholders coming in. And there was this one example that somebody had put out saying that the equity markets run all over the place, but we don't talk about suspension. There is surveillance, there is a regulator watching over it. Same is the case with currency. There's a lot of volatility there as well. But then again, RBI does say that we're curbing the volatility. We're not deciding the direction of the markets here. So why is not that example taken in for commodities too?
See, as I said in the beginning, the commodities, especially the agriculture commodities, you don't see this kind of excessive interference in the non-agricultural commodities. It's more in the agricultural commodities. And that is where I think we still not got over our mindset of 50s and 60s when there was excessive shortages of food grains and the other agricultural commodities in the country. And we had sort of put bans on the imports except for what we wanted to buy, for example, wheat at that stage to feed our people. Now, that situation was quite conducive or amenable for being sort of manipulated excessively. People could buy and store commodities, people could sort of create future speculative positions and all. And that was the situation which perhaps led to the derivatives, futures, and options at that time, futures and more, to be banned in late 50s and 60s. That could still be understood, because if you don't want to open an economy for imports, you have foreign exchange problems and others, you may have to manage the situations, and that justified bringing the MSPs and the storage controls and things like that. But situation today is completely changed. We have more production in certain commodities than the demand is. Uh, but still we are not able to get over that mindset and abolish, even enact like Essential Commodities Act for that. And we are comfortable enough in the foreign exchange situations. We're sitting over $630 billion of reserves, and we don't allow a free import of agricultural commodities. Even in agricultural commodities, we have on the net basis a net export position of about $30 billion. So even for agriculture commodities, case to case, we are not a foreign independent country any longer. Now, this situation is completely, I think, amenable and perfect for creating the situation what you mentioned about the equities market and currency markets, that you allow free flow of imports and exports in agricultural commodities, and complete hedging positions and derivatives trade. We are in my judgment, in a perfect situation to remove all the restrictions and controls and in the agricultural commodities space, and institutionalize the commodities trading, both on the spot as well as on derivatives, like the securities and the currency market. That's we should recognize as a policy, and I think we should move towards that.
Oh, that would be amazing if that happened, Mr. Garg. But I have one more question for you. And this is, a lot of people talk about India and Bharat, the urban and the rural divide here. So if you look at the budget this time around, we've heard so much about technologies and drones and agri-techs and startups and how farmers should be included within that technology line as well. And then the other side, we're just so perturbed, we're just so scared about not inflation really, but the commodity markets telling you on where the prices could be going forward. I get your point when you say that, yes, there is a mindset which still goes back to 70s and even before that. But then we are moving ahead, and we have moved ahead in so many sectors. Why not this one?
So there also, I think there's more of paternalistic attitude as far as agriculture situation is concerned, and that's largely because we have too many, and virtually everyone, barring very few, very small and marginal farmers. They on their own are perceived to be highly vulnerable to any change in the agricultural situation. So when the government talks about the drones, etc., these services, in any other economy, they should be for the private sector to provide and the farmers to avail. The government has really no business to be in that. But in agriculture, to sort of, within quote, protect the small and marginal farmers, you have government interfering with everything from the inputs of every kind, whether it's seed, fertilizer, or financing, loans, etc. or to the marketing side, that you have now MSP for all the commodities. Literally, you look at the cotton market, where the cotton corporation buys literally everything. So similarly, the drones and other technological interventions in agriculture are perceived as government sort of positive intervention in the field of agricultural commodities to help farmers. I think we should have a basic rethinking about the way we manage our agriculture. I am in fact quite open, and I think we should be looking at these even our ceiling laws, contract laws. This too much of interference of government in agriculture, in fact, is keeping, in my judgment, the farmers poor and trapped into poverty, rather than allowing them to grow, raise their incomes by 2 times or something in that. So I think we'll need to have a very fundamental rethinking about our agriculture.
Well, absolutely. And Mr. Garg, I have to give it to you because I've been listening to you for such a long time on our channels, and you talk about currency policies, cryptocurrencies, and the kind of knowledge that you have in agri as well. It's really commendable. I am so glad you're a part of this panel, and we are having such a candid
I would
conversation.
suggest you to look at my book, which is recently out now, the $10 trillion Dream. I discuss a lot about agriculture there as well.
I am so pleased. I will definitely look up for that book. Thank you so much.
Thank you,
Mr.
Manisha.
Bajoria, Mr. Bajoria, let me come to you. And much of the points that Mr. Garg put out on the knee-jerk reactions that we've seen from the government, the excessive interference that we've seen. And I remember we have spoken on the channel about these as well. Then let's have a policy, a longer-term policy. And of course, short-term policies are more like band-aids, but we need structural policies here, especially for commodities where you have international players as well being part of it, because they do not like being told on how things have changed suddenly overnight. With what has been happening with agriculture space, what is your sense?
Manisha, I would like to ask one question. Today, crude oil is Brent is $100. Okay, so you are always the explanation is there. International price of crude high, so we have to supply the crude at higher prices. So when you can do that for the crude, which is imported so many million tons with maybe 10 times more the cost that the edible oils are imported. So when any commodity, either you grow yourself or you import. And as Mr. Garg has rightly said, when we have such a big foreign reserves and we have a surplus, if you have to import a lot of quantities at even at 0% duty, what is the problem? So I would say little broader view has to be taken, that and long term Atmanirbhar Bharat, increasing oil seed production is government stated objectives in previous budget and this budget also. They have ambitious scheme for oil palm 11,000 crores, and this budget, Madam Finance Minister has announced again the oilseed development will happen maybe in rapeseed and soybean and all these things. So these are the right steps, and this will give us a fruit in 3 to 5 years, and our import dependency will reduce from 67% to maybe 50%. So we have to take a larger view and understand commodities which are not with us. We'll have to import gold. We are importing gold, so many $1 billion of gold every year, and gold is not like we eat gold. We think we are wealthy, we think we make gold jewelry, all these things. So first is food, and gold and crude and everything is else. So why are we so sensitive about them? We shouldn't be sensitive. Structural policy has to be there. Allow the import, at the same time increase the domestic production, so import dependence is lower, not more than 50%. We shouldn't have any agri commodity especially, and I think will be taken care of. And as far as the phobia of futures is there, I can say yes, as you rightly said, Manisha, that we never close our stock markets, we never suspend our stock market. When indexes were going very crazy, they were going too low, never we did all this, and we never did with currency markets. So what's wrong with the futures and especially agri futures? Why we need to close? You can have certain protections. I can say a party limit or daily fluctuation limit or margins when the market goes to up to down. These things have to be done, and these things have to be done pretty quickly by the exchange understanding the market situation. Delay in these things gives a wrong perception to the market, to the government and the players. They start thinking that it's being manipulated. And so I can say, if we do these safeguards and if we manage accordingly, then there is no problem. Futures can run very well. Price discovery will be there. Hedging and price risk management can be there. So I am of the firm view, take a broader view, take a macro view, and there is no problem. We can manage everything well. Thank you.
To you. So when we talk about investment in agriculture, with the kind of policies that we see, or the kind of suspension that we have seen, would you say that's yet another thing? Because the kind of moves that we suddenly see in agri space is not something that the investors like.
Hello. Manisha, you asked me this question. Agri space, yes, you're right. People are always scared that what kind of intervention, as Mr. Gaz rightly said, too much of government in the agriculture. So that apprehension is always there. But however, I can tell you, this taking back farm laws under the circumstances, that is not going to end the whole thing. There are a lot of things as they put in budget that we can increase the in agriculture support and new technology and new startups. All these things will benefit a lot. Those farm laws were not the only thing that could change the agriculture in India. I think what measures in these budgets are taken, they could also change a lot of things. And I think new investment will definitely come because they know we have 1.4 billion population, and we will require breakthroughs in agriculture. So I think investment will come in a matter of time. Thank you.
Mr. Kushankar, this question is to you. So, what would you say on how one can be building better linkages when it comes to spot markets, future markets, getting better investment, better credit, etc.?
Say here, CKG Nair, I think 2004, in a kind of NSE working paper or note, mentioned that the uh, ill development of the futures market, especially commodity futures market, is attributed to fragmented and unorganized spot market. So it was 2004, 2005. So just 1 year before, three commodity exchanges were set up. And of course, over a period of time, National Multi Commodity Exchange had merged with Indian Commodity Exchange in 2018. So out of six exchanges, if I recall correctly, Universal Commodity or AS Kotak Derivative Exchange, and NCDX, MCX, ICX, and MC. So only two principal exchanges withstood the test of time, right? MCX and NCDX. Now government took motivation from NCDX, promoted, I should say, N spot intervention, what do you call NEML today, and this the National E-Market, NCDX E-Markets Limited, sorry, National E-Markets Limited, in Karnataka, in collaboration with the State Agriculture Marketing Board, what we call REMS, Rashtriya Market Services, which was a joint venture between NEML and Karnataka State Agriculture Marketing Board. Now, that kind of experiment government tried to replicate in 2016 in the name of National Agriculture Market. Now, I believe that think tanks thought that, okay, if we have national agriculture market, that will contribute to futures market as far as the day one or theoretical futures placement on the exchange platform is concerned, because to for a theoretical futures pricing we need to have spot price. Okay, so without the spot price, polled spot price, theoretical futures price determination would be difficult. So once the futures contract is launched on the exchange, it was the market participants that drive the futures prices every day until the expiry, because we have daily settlement mechanism. So daily mark to market will decide that how much money to be paid to the buyer, or how much money to be paid to the seller. Fine. Now, two things are very important. This budget, there is an announcement that to accommodate agri tech startups, and farmer producer organizations. Basically, the agri-tech startups working in this agri value chain. So ultimately, they can be funded through a co-investment blended model. So blended model, I should specify that government wants to do away with grants because they know there'll be no fruitful result if we pump prime grants. Rather, somebody the every farm has to be entrepreneur. They have to inject the private equity or some debt capital or concessional loan or risk guarantee for group insurance. Fine. So NABARD has popularized some blended finance model in different pockets of the country. Fine. Now, can the commodity exchange, because national agriculture market, electronic national agriculture market, although it has surpassed 5 years of its existence, could not produce fruitful result. We don't have any data on the public domain that we can analyze whether enam contributed to price discovery or what is the co-movement between the spot prices extracted from enam platform and the concerned commodities prices traded on the ncdx or any agricultural commodity exchange. So we can't even say which market is informationally efficient. Is it spot or is it futures? Although agricultural commodities show a seasonality, so convenience still comes to play.
Okay,
Now,
let's
now we need to have one thing, that we need to some institutionalization process that can integrate enam and commodity exchange, because this two institutions should not run in different direction, should not move in different direction. Second important thing is that we need to accommodate agri-tech startups. Ultimately, it is basically identify or exploring the missing market for farmers. If the agri-tech startup can intervene between farmers and commodity exchange, say by providing advisory, by providing market arrival information, by providing market basically marketplace, online marketplace. It may not be the futures exchange, it may not be the spot platform, it may be simply a kind of a retail online marketplace. So technology, understanding of the market, and market social capital, because it is not about village social capital, it is about how we can invest in market social capital, how one farmer can understand the law, legalities, how can farmer can comply with the regulation. That's very important. And now I think SEBI, because we as an academician, we believe that I think 5 years back, that if the SEBI became the super regulator for commodity derivatives, probably the SEBI's bandwidth and expertise in regulating the stock or the capital markets could, reflect the better functioning of the commodity derivative markets. But it is not the case. And Forward Markets Commission became a small department of the SEBI. So which should not be the case, because we have to take very benchmark practices from the Chicago Mercantile Exchange Group and Intercontinental Exchange and other global exchanges. Especially we can take the example from three exchanges of China: Shanghai, Zhengzhou, and Dalian. What remarkable the kind of experience these exchanges documented over a period of time, that we can definitely refer to. Another thing is that academicians should write some teaching cases or illustrative cases on commodity exchanges while taking these cases to the classroom. And if we search on Harvard platform or IB platform, we hardly find any India adaptation case on the commodity exchange, especially agricultural commodity exchange. Nowhere you will find a single case written on a particular commodity group or particular exchange. So that's why most of our the students, the especially MBA students, they are not aware of how a commodity exchange works, or what is the relevance of agricultural or kind of or energy products in the economy, and what the kind of relationship they have with the macroeconomy. So I think Apart from the institution building, I think sensitization of this generation about the relevance of futures markets and tracing to Kautilya's Arthashastra 400 BC or 250 to 300 BC, where he mentioned this Gali, Fatak, Teji, Mandi. So basically nothing but forward and options. And the last but not the least, how we can integrate the capabilities of agri-tech startups into this agri-commodity space, that will determine the degree of marketplace literacy and market social capital leveraged on harnessing the benefits of exchange platform. Thank you.
Mr. De, I remember those years of Gali, Fatak, Tezi, Mandi,
Yes.
Badla. Yes, we've all come from those kind of levels, and we don't want to go back there, right? So there is something that needs to be done. Kapil, this question is to you. And while there are so many products available right now, you can trade, you can manage your risk, there are spreads, there's arbitraging opportunities, there are options, there is an index that you can trade in commodities. But then again, the kind of attitude that we've seen among regulators perhaps, and the kind of awareness that we still need to create, and the kind of trust that one has to keep building yet again and again, with the kind of back and forth that the government does with this space, that's a lot of work, isn't it?
Manisha, I think a lot need to be done. So risk remain the least priority for Indians. We know it, whether it's health, whether it's personal, whether it's home, whether it's business, or whether it's the prices. And this is the fact that in a large economy, government cannot ensure risk management for everyone. So the practice of risk management needs to be talked on the larger level, right? China has done it, right? They have pushed the business to the extent that if you don't hedge, then you have overall, in the financial ecosystem, you cannot get the free lines, you cannot get the credit lines. So because it's not about you being protected, it's about you have as an entity impact on the ecosystem. And we have seen, if few participants, a few large corporates got busted because of price or any other reason, the impact economy can have, the banks can have. This is point number one. And point number two, the Indian market, yes, it has taken small steps with a lot of roadblocks and barriers. But I would like to mention we are very different from the global market. We settle ourselves on the spot market to ensure that it is aligned with the spot market, futures is aligned. It's compulsory delivery contract. Most of the contracts are compulsory delivery contract. We have delivered almost 12 million ton of goods now since inception. Last month we have achieved that mile, right? And the margin risk framework is very different from the international, where seaboard may have around 5% margin on the seaboard, and when the extreme volatile situations are there, they increase by 0.25%. Or we have margin level, of 25%, 30% now. So we are already sensitive about the prices and how they are getting traded, and around all the rules and regulations which have been built around commodities are in line to that. So we know that there will be certain discussions happening if prices move in a particular fashion or one particular segment is impacted. But end of the road is that this market offers solutions to everyone. We are sitting on certain commodities where we are oversupplied, as we discussed earlier in the panel. We are struggling, to find a place in the international market because our base price is high. In certain commodities, we have actually given subsidy to get the things export. In certain commodities, we are struggling where consumer are paying high price. So when we are talking about, giving high price to farmer and low price to consumer, it's a very cautiously has to look into. And maybe rather than following the traditional approach, we have to see that how market can offer solution to all these aspects, how farmers can be protected using derivatives market, whether it's put options, which SEBI has allowed us to do, and we have really demonstrated that farmers actually can lock the prices which they feel are good for them at the time of sowing itself. Consumer can protect their prices rather than actually questioning the prices or maybe the blaming the market prices using derivatives market. And as I mentioned, the Starbucks has done it, various other companies they do it, and in the global market is the most followed risk management using derivatives tool. So I think a lot of awareness need to be created around this market. Practice of questioning the prices need to be stopped, and maybe to counter the price movement, a lot of the right information need to be provided to the market, to the policymakers, to the regulator, and the focus should be given on those aspects. Once this ecosystem developed, we have next level of derivatives market in India. I don't think that these type of discussion will be having that whether prices are right or wrong. We have to accept that prices are always right, which is driven by the market, and we need to find a way to manage if we don't find it right. So we have been pushing that, Manisha. Of course, we'll keep on adding the new instrument. We have added agri-dex. We have added few more index. We are now focusing on the options. Options and goods are also available. So as an exchange, we firmly believe that this market offers solutions to so many things, not only the price, but infrastructures and various other issues as well. And we'll keep on pushing it, and we'll keep on creating awareness uh, max possible at our end. Thank you.
Kapil, thank you. Your point is well taken. And we have a couple of questions as well coming in. Let's take them as well before we wrap it. And this one is from SL and is asking that does high volume of cash settled trades suggest any speculative use case of derivative markets? Kapil, you want to take that because this is some data that we do use in hand. So whether it is delivery or it is cash settled, does it give you an understanding of how the market is treating the derivative space?
No, actually, no. Yes, deliveries have a bit of concern because this is a very specialized space. Only few people who are exposed to physical market can handle that. So preference of rest of the share market remains trading a contract where delivery is not an obligation. They are using it only for the price risk management. But as I mentioned, the Indian derivative mechanism has been designed in a way that end of the day, whether it's cash settled or whether it's a delivery settled, the final settlement price are driven from the spot market or spot prices of that market. So ultimately, whether prices is whatever, end of the day, there is a forced conversion which happens through the mechanism and positions are settled at the spot market. So it doesn't make much difference. But yes, there is a bit of comfort in few segment of the market participants where deliveries are not there.
I will take one more question, and this one is posted by Pankaj Bhatt, who asks, and it's quite relevant. And Mr. Kushankar, why don't you take this
Yeah.
question? Because it
Yes.
says that hedging is less known phenomena when you talk about farmers. The state research, the universities, the kind of support that should be extended towards for this ecosystem is way less.
Yes, this is a quite relevant question because we have 60 odd agriculture universities and several, near about 100 agriculture research institutes funded by ICR and the state. But the thing is that there is a disconnect between the market orientation and the production kind of led intervention in agri. Now, agriculture universities imparting knowledge or kind of whatever we say skills go to the field, maybe to the restricted to the farmer or a KVK scientist. Now, when it comes to the market or kind of exploring the missing market where I can sell off my produce, or even where I can keep my produce for some time, when the price will be high, then I can gradually dispose my produce to the market. So either this is not in the syllabi of the agriculture universities, or even if it is in the syllabi of the agriculture universities, agricultural economics and agriculture extension are most a kind of a kind of look down upon streams compared to soil science and agronomy and others. Okay, now second part, market related interventions starts from the at the state level, block level, kind of village level. Now this hedging kind of activity, because if I have something underlying in the cash market, so I basically hold that produce, whether it is chana or kind of moong or kind of paddy or wheat. Now I want to see the what is my cost of production and what kind of the return I can get by selling this produce. Now during harvesting, it is obvious that there will be market glut, and I will be a victim of the distress sales. Now to avoid this distress sales phenomena, you have one farmer or one entrepreneur can have two, three choices. Either you can hold the produce. Again, the flip side of this, you are cash starved farmer, you need to have some cash to buy inputs to run the next season. Okay, so first option is now ignored. Second option, If you are a part of a producer organization or cooperative, can cooperatives warehouse or storage structure be utilized? Now we have to do kind of research. What is the penetration or density of the village godown, or small 700 to 800 metric ton warehouses in our hinterlands? So most of the cases is not possible because cooperatives are the defined structure. So that's why, to overcome that structural problem, government has initiated producer organizations. Now producer company, what we call in the India's Companies Act. Now this producer company, either hire purchase your godowns, or kind of on the lease basis you can use the space, so that you can avoid the distress sale and you can gradually dispose your produce to the market. The third option, getting the right price from the exchange platform, and you can compare the price with your market. What differential you can, what differential price you can earn to obtain the right information from the exchange and participate on the exchange platform. Okay, so if you want to really, if you're a risk averse farmer, you want to utilize the market opportunities to the fullest. So exchange platform will be an kind of very feasible option, given you comply with the regulations, the regulatory architecture of the exchange. Okay, then probably this you can hedge your underlying, not to the full extent, maybe 50%, 60%, because if you want to hedge your underlying commodities available in the cash or spot market, the outcome of the hedging does not always turn out to be positive, remember. So that's why we call hedge effectiveness. To what extent your hedging strategy can provide a certainty in terms of outcome. So if the certainty is not that great, not 90%, 80%, you should not hedge 80% of the exposure. Rather, you should hedge 40 to 45% of the exposure, and remaining you can keep either in warehouses or you can play in the spot market, having an arbitrage, kind of. Thank you.
Well, yes, that point is well taken. And, yes, not only have we talked about the issues during this conversation, but we have suggested solutions as well. We've pinpointed on what the pain points here are also. And this has been a very enlightening, this has been a very helpful conversation, gentlemen. But with that, that's all the time that we have on this session. Thank you so much, Mr. De, Mr. Garg, Mr. Bajoria, and Mr. Dev as well for joining us today and taking us through this conversation. We thank you for your time. We appreciate your patience as well. And we thank you, the participants as well, for sending us those questions and listening us through. Thank you so much.
Thank you.
Thank you.